Welcome to Buy, Hold, Sell. My name is Matthew Kidman and today we are talking banks, the biggest sector on the Australian share market and a sector that a lot of people have shares in. With me today is Phil Parker from Altair Asset Management and Ben Rundle from NAOS Asset Management. Welcome, gentlemen. Phil, I'll start with you.
So recently we've gone to an underweight bank sector but an overweight NAB. Main reason for being overweight NAB's the catalysts that we see driving the share price. I've got a TSR, a total shareholder return of about, well, in share price about $42 from here. We see the main catalyst being selling off the non-core assets, being very ruthless on their costs.
Okay, and what don't you like about the other three big ones? We'll stick with the big ones.
So ANZ would be our next preferred. We're kind of slightly overweight to just underweight. What we like there is the increase in the home loan numbers. They're running at about 8% growth both on the home loans and on the corporate loans. So that's good news, above system for both of those. Probably some issues on the institutional investment bank, but my view is they'll muddle through that, and I think Asia will pick up towards the end of this year, early next year, with more cuts and rates in China. And then with CBA probably next, and then Westpac down the back of the pack. The only reason that we're putting the more retail banks, the home loan banks towards the end is, with risk-weighted asset changes coming through, as was mentioned today by buyers at the review today. We would probably say that those guys would probably have more capital to put on their balance sheets than the other two, who are less focused on the home loan market.
Okay, Ben, talking about capital requirements, APRA did come out recently and said it's going to happen sooner rather than later, the increase in the capital. How do you think that affects the whole sector?
I think that's obviously a risk to be cognizant of, but for the near term, I think the banks are probably well supported. I noticed the whole market's kind of gone to a consensus sell on the banks. I'm not quite so bearish. I do think the capital requirements are a risk, but I think our banks are quite well capitalised at the moment, so I don't see that as being too damaging to share prices in the near term. And I think that with rates the way they are, that the dividend yields are still pretty attractive, and I think they'll be well supported by that.
You're not worried about the ability to grow in terms of profit?
Yeah, that has been an issue lately. Look, I think it'd probably be subdued growth, but again, I think the share price will be well supported by the dividend yields.
And is there any bank in particular you like out of the big four?
I'd probably favour ANZ, purely on valuation basis. I think they've got good growth into Asia as well, so probably ANZ on valuation, I guess. And
Phil, are you worried about earnings growth? Because they've written back a lot of provisions that they had post the GFC. Yeah, that's coming to an end now, so growth may be harder to get.
The over-earning argument. There is some real credit to that argument, but really I think you're going to see, certainly with ANZ, maybe with NAB, you're going to see somewhere between 3 and 5% normalised earnings growth for this half. The other thing I think is if you look at NAB, there's some really early green shoots coming through for corporate loans picking up, and they're really highly leveraged to that in terms of growth from corporate business. So I think earnings are going to be fair to reasonable. I don't think they're going to be great, but as Ben was just saying, you've got the differential between a very low 10-year bond yield, very low TD rates, with sort of 4.8 to 5.5 dividend yields on these stocks pre-franking. I just think they're still attractive. There's no real left field event that's coming that I think is going to knock the banks out. And just on the APRA and on the timing of all of that, I think they're going to be guided by the Basel IV requirements, which means you're probably looking another 18 months to 2 years for Basel IV to actually say this is what we're going to do on the DSIB banks, and where we lie with that. So there's going to be changes. Obviously, risk-weighted asset controls are going to go up. But I think it's over a longer period of time than most of the sell side is recognising at the moment.
And Ben, what's an acceptable yield, especially among the big four? Is it 4%, 5%? Where do you think it?
Yeah, look, I mean ANZ and I think NAB are around the 5% mark at the moment. I don't see that as if it was 4.5%. I don't think that's unreasonable given the rates environment. CBA is a bit lower, but it's a much higher quality bank. So I think 4.5 is probably acceptable.
There you go. It's had a great run, but if you are choosy and selective, you can still make money out of the banks.